JPMorgan's chief market strategist, Jan Loeys, joins us now from New York. Thank you very much for joining us today.
My pleasure.
Let's take a look at what you're expecting the Fed to do today. Do you see QE3 or do you see this operation twist?
We don't really expect a repeat of QE2 with an expansion of the balance sheet. There's a lot of opposition to that, as you know. More likely, they'll do the last few things they can do. Indeed, an extension of the duration of their portfolio, possibly a reduction in interest rate on excess reserves, and maybe some language that makes the ultimate raising of interest rates conditional on the unemployment rate. A combination of those is likely what we'll get.
You said the last few things they can do. You clearly feel that they are running out of options here.
I think we're out of guns in monetary policy. The ball is in the court of fiscal policy at the moment. The 10-year yield in the US is below the level it ever reached during the Great Depression. We're not seeing any transmission of low bond yields to the rest of the economy. The corporate sector has more profits than what they currently need to fund their own capital spending. So it doesn't matter how low you make corporate bond yields, that's not going to affect their capital spending. Same thing with the consumer. A lot of people are underwater on their mortgage, so it's going to be very hard for them to refinance. I think monetary policy is finished and now needs to look at the question, can it do more damage than it can do good at the moment? What is holding back the economy is brute uncertainty. Uncertainty about what corporates, what consumers are going to do, and what policymakers are going to do. The picture in Washington is very ugly. So I think Mr. Bernanke needs to be very careful and not get too creative, because that could create more uncertainty and be more damaging ultimately to the economy.
Yeah, do you feel that maybe Ben Bernanke is tinkering too much? I mean, there does seem to be quite a difference in what's happening on one side of the Atlantic and the other. He may be micromanaging things, whereas here in Europe, where the leaders are being accused of not doing enough.
Well, I think both monetary policymakers in the US and in the euro area face a problem that the fiscal side is not doing its job. In the US it's total chaos, and in Europe I guess we have to call it chaos too. What is missing in Europe is a consolidated federal fiscal policy for the euro area, and as a result it has forced monetary policy makers into too much creative action beyond what they should be doing.
Now, the IMF has said today that the European debt crisis has generated as much as 300 billion euros in credit risk for European banks. Surely that must make investors very nervous.
Well, yes, it has created that, but Europe's credit losses are largely of its own making. The euro area has a low deficit, has a manageable debt load, and is not dependent on foreign investors, at least not outside the euro area. It is simply the euro area is not functioning as a single country. There is a distrust, one side versus another, unwillingness to help each other. And in that environment, you're creating massive losses. And the ultimate damage could simply be that the euro area falls apart. And then that number that you're quoting is going to be a low estimate of how much will be lost.
Indeed, if that were to happen. But how likely do you think that is the outcome?
I'm on the side that says that it will not happen, that ultimately Europe will pull together when it faces the breakup risk, which will destroy all the banks, will destroy a lot of the corporates, and which is not going to create a depression. It's going to be much worse than that. So right before that, Europe will make the choice and use the least painful one. The least painful one is that the euro area countries pull together, effectively lose their independence, and combine forces and create a fiscal equivalent of the ECB. We're in the ninth inning at the moment. We're seeing capital flight across Europe. across the euro area, the monetary union is starting not to function anymore. There's distrust about what a euro in France versus Italy versus Germany is really worth.
May I ask you, where do you position yourself in the middle of all of this? It's a fairly grim picture out there.
Right.
Do you still favour the US over Europe?
Well, these are choices between a lot of unattractive options at this moment. Each region has its problem. Emerging markets looks best at the moment, clearly, but in a recessionary high-risk environment, money simply pulls away from emerging markets. And we see this now. We have collapses in a number of emerging market currencies. Nothing wrong with these countries. It is simply in a recessionary risk environment, money pulls back into the US dollar. So you got to stay in dollars at the moment, a bit the yen, not the euro, not sterling, not emerging market currencies at the moment. You got to be defensive until the fiscal policy makers, that is both on the US and the euro area, take the right actions. We're not there yet, but we're not a year away from it either, because things will get much worse.
Okay. Jan Loeys there from JPMorgan. Thank you very much indeed for joining us.
Welcome.
And Jan there telling us we should stay in dollars.